Bitcoin, Ethereum, Solana, you name, XRP, that they're just all crypto assets. They're all the same. We're going to $1 million Bitcoin price where we break things and Bitcoin is the one thing that stays intact.
Back in 2012, Bitcoin was far from the polished investment product we know today. There were no user-friendly apps, no regulated ETFs, and certainly no institutional custody solutions. People interested in Bitcoin often had to navigate unreliable exchanges like Mt. Gox, configure mining software manually, and trust technology that seemed experimental at best. Even professionals working inside major financial institutions hesitated.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Kind of 2012 era, he had brought up the idea of mining and mining Bitcoin at the time. And we were laughing about the fact that we didn't have any hardware that had enough memory to actually to set it up on, and couldn't figure out how we were going to do that. It was also very treacherous back then too. There was nowhere, this was not an era where you went to your Coinbase account and you logged into a nice web browser and deposited your Bitcoin. Basically, your alternatives were something like, Mt. Gox that you could potentially engage with. And again, at the time I'm working at Morgan Stanley, I'm like, man, I'm going to get fired. This is definitely something that's going to be a bit more difficult for me to do. So I spent, even though I had a lot of knowledge and spent a lot of time watching the journey unfold, I was definitely not sitting on my computer mining Bitcoin in the early days.
Well, this is kind of a big question, but if you could look at your time at Morgan Stanley in the emerging markets kind of sector, what is a takeaway that relates directly to Bitcoin catching on? Is there something that you think, oh, this makes sense because of the lessons I learned working in emerging markets?
Oh, yeah. Looking back 2007, so before the global financial crisis, I think everybody's pretty familiar at this point with M-Pesa and mobile money, that the way it evolved in Africa and across many other parts of the emerging markets. But we had invested in Safaricom back in 2007 when they IPO'd, right around that time, 2006, 2007. And it was amazing to see the mobile money and payment infrastructure, digital payment infrastructure catch on so early. And we couldn't relate to it in the US because we just didn't have the problems that they had in terms of that, the infrastructure. And they were also on they were on flip phones. Doing this stuff. This isn't a smartphone era. This is the banks were not, formal banking was not well developed in many of these markets, and they would rely. And even I spent time in Tanzania a couple years after that, and it was just amazing to me to be in the smallest villages. We're talking electricity that was not on 24 hours a day, dirt roads, and there would be a Vodafone that looked, no kidding, you made a lemonade stand as a kid, and it would say M-Pesa, and that's where you could take your money and load it on to your digital phone. And that was just where you just see that in person, and just how deep that infrastructure goes through, and was so, these populations just relied on this as the only option they had. And also the safety that it brought for a lot of these populations. If you think about even women that would take their goods, if it's vegetables or bread or anything else, to the market and sell it, once they left that market, they'd have to travel home to their local village, and they would historically have a bunch of cash on them. With mobile money, they can actually eliminate that risk of getting cash stolen and just have it on that digital card that offered a different level of security than they even were used to before. Again, these are just concepts that do not totally relate to what we deal with in Chicago or New York. And maybe just to give people like a little lay of the land, Morgan Stanley has multiple different divisions. We have our institutional securities business. So that's kind of what you think of as like investment banking, sales and trading, research. Then we have our wealth business. And even within wealth, we have a couple different components. We have financial advisors, and I know we'll talk about the financial advisors today a little bit. But we also had acquired, COVID was a big era for us. We made a number of big acquisitions during COVID, one of those being E-Trade. And that's self-directed, online trading and really opened us up to a whole different client base through that self-directed technology platform. And then we have our asset management business. And so that is, manufacturing of products, everything for corporate pensions, sovereign wealth funds, but also mutual funds and ETFs that we distribute not only on our wealth platform, that's one channel that we can distribute it, but also across any other distributor that we have a relationship with. That can be other intermediaries, other banks across the U.S. and across the world, and we manufacture products there. So we have a very diverse business, and it's really exciting to be able to tap into some of those offerings across multiple divisions. So as you had mentioned, Bitcoin. Just the Bitcoin exposure, we have the Bitcoin ETP, so that's coming out of our asset management business, and then also spot trading, which we're just in the process of rolling out now. So you'll be able to actually buy spot Bitcoin on E-Trade. There have been some pretty heavy duty regulation to limit us. I mean, because even if you have to understand, actually as our asset management business, and I sat in our asset management division for many years, so I'm very familiar with that division and sat on the operating committee of our asset management business. We're different than BlackRock. BlackRock is an independent asset manager. We have an asset management business, but we are owned by a bank holding company, meaning that we have other requirements that we have to adhere to, and we are governed by the Fed. And that was one thing for us that limited us from rolling out some of these products as early as some of our peers that are independent asset managers. And, it was very hard for us to watch that. As you could imagine, you're sitting here watching your peers that are asset managers in the space rolling out crypto products. And you're like, why can't we do this? So there was some limitation there to what we could do. The one thing that was actually interesting about the spot crypto business on the E-Trade side, which I think is still to this day very aware of, especially overseeing digital asset strategy now. Many of the vendors, so we actually had a plan that we had worked on years in advance to do this. And unfortunately, in the era of, say, like 2020, 2021, some of those vendors that we had even done due diligence on and assessed and even shortlisted for potential partnerships, they no longer exist.
Oh, wow.
So we really had to go back to the drawing board in 2024 when we started this initiative again to really go live. And we had to rebuild our whole plan from scratch because a lot of the previous the work we had done, we couldn't actually use. We had a fair bit of feedback from the street that there was a need for us to get involved in this space. But we also had a fair bit of feedback from the street, like, why do you guys need to launch this? We already have 20 some, Bitcoin ETPs, and what's different about your product? So we tried our best to differentiate and bring that institutional construct to the ETP when we launched it. We came out to market at 14 basis points. So we worked very hard to try to really get that cost basis down in terms of a overall management fee on that ETP. And then also when thinking about the custody. So we had partnered with Coinbase and BNY, were the first ETP in the market to actually work with BNY on ETP custody there, and that was important. So basically having GSIB issued and GSIB custody was the first thing that we really wanted to try to get to market.
Bitcoin, therefore, occupies a unique position. It is increasingly accepted as a legitimate asset class, but it remains categorized as higher risk. One reason is Bitcoin's price behavior. Despite narratives describing Bitcoin as digital gold, it often trades similarly to other risk assets. Inflation may rise while Bitcoin falls. Technology stocks may decline while Bitcoin follows. This inconsistency creates confusion among investors.
We have made recommendations for our moderate to aggressively moderate portfolio. So it's not all of our clients. It's those that where more it still falls into a riskier bucket. Now, you could probably debate me on that, but it's just kind of where we can even talk about that a little bit, because even we see inflation going up, but yeah, we see the Bitcoin price going down. There's, it's still moving with risk assets. For sure. And I wish it moved a little bit more as that real asset gold. So there's still that price. That price challenge and the movement of the asset that I think is confusing to clients, where does it fit in? But that being said, there is recommendation. So 0 to 2% in some of the portfolios, 2 to 4 in some of the more aggressive portfolios. And, I think it's, I think there's a question. Since we've come out with many of those recommendations, the Bitcoin price hasn't done that much, right? So I think it would be one thing if we were making that recommendation when we were 10 or 15,000 and then we were at 100,000. I'm sure you'd get the momentum would be behind you. But interestingly enough, since we've been in this journey, we've been pretty range bound. And granted, we kind of made it up over, 100,000 there for a while, but we're kind of back down in this range, almost where the ETPs launched, I think, right? Yeah. So, I think that gives pause to how is this really going to move? Do we believe? You look at you pull out the long-term chart, and the long-term chart's there, but that psychological element's really a tough battle, especially with, I think, all the other asset classes that we're dealing with right now. If it's private credit, that's a hot, subject that we've been dealing with the last couple of years. If it's confusion around AI, can AI go higher? And then, no, it can't go higher. Yes, it can go higher. It's still going higher. And how you're managing that relationship with your client. I think the other thing to just keep in mind too is not every client is a growth investor. Yeah. So you have to think about the financial advisors do have fiduciary responsibility, and they do have to find those assets that are appropriate for their client at hand. And many of our clients that have significant wealth, some of them love the innovative stuff and they will ask for it. And some of them are also okay sitting in more reliable assets that have just strong yield and more of a capital preservation focus on it. There was momentum because you had so many of these new products coming out and you were able to distribute it more. But then even last year, we had this crazy gold and silver trade, this commodities trade happen. And somebody at one point mentioned to me, we took interest away from crypto because it all went over to just commodities trading. And so when you start splitting your focus in terms of that asset allocation, I think even the AI discussion that continues to be a battle. It just can, and then quantum, you introduce then it's throw in some confusion on quantum, and maybe you should sell your Bitcoin now because quantum's just going to blow up everything, and I might as well exit at 70, and depending on when you got in, and focus on the next round of innovation. I think there's that battle, oh, this is old tech, we need to move on to new tech. So there's all these narratives that really get thrown in there and confused. So that's a little bit frustrating to navigate some of those narratives that take hold. Crisis, crisis events totally transform our thinking on things. And we sometimes like never return back to like the old thinking. And I hate to say it's going to potentially take a crisis. I sometimes think it could be like a slow grind crisis, that it doesn't actually, it's not as dramatic as COVID or as global financial crisis. But I don't know. I think it might take something. I hate to be like dire about it, but like it might take something like that where like we break things and Bitcoin is like the one thing that stays intact. I think there's a lot of the digital asset activity interesting for me because my journey started more in the Bitcoin side. And I'm a believer in this like decentralization. I mean, especially coming from emerging markets, like making sure that even if like, electricity or like an entire country collapses, you will still be okay because the ecosystem and the blockchain will be sustained by other, supporters of that ecosystem all over the world. Mm-hmm. And we're building a lot of digital asset stuff in very centralized ways now. Mm-hmm. And so I don't know if it takes something goes wrong there to return back to this decentralized discussion. Not being, burdened on capital treatment for sure. And I think also just being able to look, banks aren't doing it because they don't like Bitcoin. Banks are doing it because like we're running a business too. And if there's more efficient assets from like either like a capital treatment standpoint or from a regulatory standpoint, we're focusing on those. It's not specifically like an anti-Bitcoin stance. It's just we need the environment to also be supportive of leveraging that asset from a collateral standpoint or from transaction and ecosystem standpoint as the same, and maybe even just to like zoom out a little bit and not just make it about like Bitcoin. We were in a meeting today and we were talking about tokenization and tokenizing equities, because of course everybody's like hot on the tokenization topic again. And if nobody wants, the tokenized equities, like there's not a lot of reason to spend too much money doing that until we can like see the momentum. I mean, we can get ready for it and we can support it. But at the end of the day, if the traditional assets are where the lending is needed, we can stock lend or offer services around those traditional clients. We'll do that. Now, if the demand comes and there's the demand to do that for tokenized assets, we'll do that too. The misunderstanding, especially as you have like a rollout of crypto assets that like Bitcoin, Ethereum, Solana, you name, XRP, that they're just all crypto assets. They're all the same. They're not all the same. They're very different. Each one of them is different in its own way. And I think at some point we'll spend more time talking about those differences again. But right now, it feels like we've kind of hit this consolidation of like they're just crypto assets, especially as you see more focus with a rollout on some of the centralized platforms. And I do think we probably need to you always do a good job separating that in terms of your focus on Bitcoin, but I do think we probably need to spend more time talking about some of those differences.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.